Hi, I'm Josh Malinchuk with JM Tax Advocates. I'm here to present some helpful planning ideas around these uncertain times with COVID. And specifically, I'm here to help you understand how best to manage and avoid unexpected property tax increases during this recession. A little bit about my background. I've spent the past 28 years helping clients out with ideas to lower their property taxes and procure economic incentives during times of business growth. Prior to founding JM Tax Advocates 10 years ago, I spent 18 years in public accounting as a national tax expert for a top 10 regional accounting firm, and also as a tax director with several big four firms. And so I'm here today to help you understand the who, what, when, where, why, hows for property tax relief. About JM Tax Advocates, we founded our firm 10 years ago based upon three client-centered principles of integrity, honesty, and fairness. Our goal is to always become your long-term business partner, and that drives our everyday behavior to help you secure relief and act in your best interests. And so we specialize and provide services in three primary areas. And these are property tax reduction advocacy, value-added property tax compliance planning, and achieving maximum level state and local incentive procurement during times of growth. So understanding property taxation. So who is responsible for assessing property? Well, that answer depends on whether you're talking about personal property or real property. In general, real estate is assessed by a county or state level assessing official. By comparison, the personal property usually starts with a self-assessment on a personal property return filing, and then later a certification or an estimate of value by a local or state assessor. What property is taxable or exempted? That's a really important question because that answer may vary depending on the state for the filing or based upon the state of assessment. When is the property valued? Most often that answer is January 1st, although several states have alternative assessment and lien dates for property assessment. So it's important to know your state. Where should it be assessed? That answer is easy. The property should be assessed for taxable property based upon that assessment date and the location or situs as of that specific date. As we mentioned earlier, how the property is assessable can really vary depending on whether it is deemed to be exempt or excludable, or if the value premise is different than fair market value. That methodology may vary greatly. And so again, it's important to understand your state assessing methodology so that you know how best to evaluate your assessment notices year after year. So it's important to not forget about property taxes. How many times do I see a business that is managing on a percent change method from year to year? So in other words, if the value doesn't change much, there's no action, no review. You kind of end there, so to speak. And so we'll get into this a little bit later in the presentation, but using that percent change method can really create some unexpected surprises when property tax rates are expected to fluctuate from year to year, such as these times. So don't forget about property taxes. That's really important. So, most of the time, capital intensive businesses are paying significant sums of property taxes. It's likely that if you are a capital intensive business, that property tax is your number one or number two tax burden. It's staggering to know that 80% of the time we find savings or overages with assessments by as much as 20 to 30%. And so imagine being able to take that overage, possibly in the hundreds of thousands or millions of dollars, and put that to better use in other strategic areas of your company. So that is really why we're here today, to talk about how you can best change your management of property taxes to work for you versus against you. Property tax periods are almost always time sensitive to a particular period or a particular date during the year. So again, it's important to know your state, but it's also important to understand whether there are some jurisdictional differences for those deadlines. For instance, if your deadline is based upon notice mailing dates, the answer for the protest period may not be a set date during the year. In fact, it may be staggered by county or by batch within the county. And so monitoring your assessment notices, which typically carry a very short window of time for filing protests or appeals, is a really important step for your property tax management strategy. Other area that's important to understand, especially these days, is that the tax rate, which is applied to your assessment to come up with your tax bill, may create some surprises if that rate fluctuates wildly. We also expect that starting with next year's assessment, there will be even larger assessment disparities between what the assessment notice says and what is fair, accurate, and equitable for you as the taxpayer in that jurisdiction. So don't forget about your property taxes. The other important facet to this is that despite all of the pain and unpredictability and disruption to your business that COVID has rendered, COVID can actually work for you when you're talking about reducing your property tax assessments. But it's important to also understand that the rates may create this perfect storm with extraordinary property tax bills because of these rate fluctuations that are now becoming known and public for many jurisdictions. An example is that Nashville, Tennessee, obviously a major city in the United States, has publicly admitted that they will be raising their property tax rate by 32% come next year with the tax bills. In California, there is already some movement afoot to remove Proposition 13 for commercial and industrial property owners, which would create billions of dollars in additional property tax burden to those capital intensive businesses located in California. So these are just two examples of many that we expect to see as part of massive rate fluctuations due to COVID. And so just to kind of prove the point here about why it makes sense to pay attention to your property tax rates, is this very simple example. And let's just go through this theoretical model and just assume that in 2018, you have a property that's been assessed $15 million. Well, that assessment has stayed relatively flat. In this case, it's the same value for 3 years. You're cruising along, no change, no reason to worry, no tax appeal. Well, starting next year, because of this rate fluctuation, your property tax bill is going to go from $345,000 to $450,000. And in this case, because the tax bill timing is past the protest period, you'd have no means to rectify or head this increase off at the pass through a property tax appeal. So this just kind of highlights that, if you have a situation where your property tax rate is expected to fluctuate wildly, it's important to pay attention to your property tax assessments leading up to that bill to make sure that you are not over-assessed or inaccurately assessed with your property assessment, because not doing so will magnify during times where the rate is expected to increase. And in this case, think about it, with COVID, everyone is facing some increased costs of operations doing business, if you will. Businesses are seeing this, and government is not immune from some of these same costs. And in fact, we expect to see large-scale cost increases with the government just to keep their fire, police, and school systems in operation. And so who is going to absorb these extraordinary costs? Well, it's going to flow through to the levy, through the levy process. And if you're a capital intensive business, you're going to feel the impact of that tax rate increase, possibly in a substantial fashion, in a similar way that this example proves. And so the other element that's worth mentioning is that COVID may impact the value of many different property types. And so, some of the symptoms of loss in value typically stem from a business decline in revenue, utilization, occupancy, and rising costs of doing business. And the impact may vary depending on the property type. There'll be lots of winners and lots of losers with all of this. And so it's important to understand the impact of value for your property, because your state assessor is not likely to fully capture the loss in value due to COVID. And so it's important that you as a taxpayer and as a taxpayer advocate, that you're paying attention to symptoms of economic loss or obsolescence, so that that is properly implemented into your assessed values of real property and possibly personal property if that's assessed in your particular state of operation. So where do we begin to investigate and highlight planning opportunities and overage with property assessments? Well, that usually starts with looking at the latest property tax bills, looking at the last assessed value, reviewing personal property filings and fixed assets to start to formulate some initial areas of investigation. We find that tours and meetings with facility and accounting personnel is always a great start, with some interviews to understand the function and the history of the property that we're reviewing. Fundamental market analysis is always the center point for the property tax review, because we're wanting to compare that to the initial assessment data or the latest assessment data as part of our step one gathering. And then it's important to map out a calendar, whether that's statutory or what you would call a notice of value state, to build that predictability for action and to know around about when the protest periods start and end, so that that is planned in to the property tax management and review function for the current year. And then leading up to that point where you receive the notice, you'll have that market analysis, the fundamental analysis in hand. Potentially you'll have amended returns ready to file, and have some positions to implement in the current year filing. So you're already starting to achieve relief as part of that property tax management planning. And then once you've taken action, either through appeals or amendments, the last step is important to know that you've sealed the deal, you've crossed the finish line, that the settlement or the expected assessed value through amendment, it has been properly implemented through a tax bill review. And so, if the tax bill's not correct, many times there'll be some time-sensitive action to get that correct so that you're not overpaying as part of your accounts payable process for that year. So COVID, that's a really big area that could materially impact your assessed value if you've been impacted. And so it's important to ask some good questions that would lead you to believe that, yes, indeed, COVID has impacted my property. Yes, indeed, I should be concerned that I'm not overpaying this year with the assessments. And so if your sales revenue, if you're incurring additional expenses that you've not seen historically, if the business has been facing equipment downtime with shutdowns and utilization has been impacted, have I had to lay people off with my workforce? And what's going on with my supply chain? Have I seen disruptions with getting my raw materials or component parts? And am I seeing increased costs of freight and also of the components because of a number of reasons? Well, if enough of those are yes answers, you probably have a case for COVID relief for your property assessments. And so we also have a great deal of experience with manufacturing properties. And what we're seeing in the marketplace is that about 80% of manufacturers expect that the pandemic will impact their business. And so it's important to understand that and to understand how downward pressure on demand, production, and revenues has been happening with COVID. And so, again, that industry knowledge and understanding how to translate those losses can mean a great difference with attaining meaningful property tax relief. We need Hannah to stop talking so loud. So obviously, if people aren't traveling, another property type that has been impacted these days in a dramatic fashion are your hotels. And so there are numerous articles about how the hospitality industry has been impacted. And with the travel industry, the problem is literally 9 times worse than the September 11 crisis that led to our last recession. And so if you look at the occupancy and RevPAR and average daily rate, those have all plummeted in comparison to prior years. And so very devastating impact to hotels as a whole. Another property type that we've seen being impacted by COVID is, all of your senior care properties, such as independent living, skilled nursing, assisted living. The first area that has impacted all of these property operators is the massive increase in costs. And so on average, the communities that have managed to dodge COVID-19 are still seeing an increase of 73% from year after year. And if COVID positive has impacted their location operations, they're seeing a 103% increase in costs. And so these were all unexpected, not foreseeable, and these would generally add to the risk of owning these properties and also a corresponding value impact through the same increase in costs. Another area that has hit home is that staffing costs are going up. Uh, Communities are looking at an artificial uh, uh, stopping point for accepting new residents, and so that's hitting them on the top line revenue side. So by and large, we're seeing resources that quote 40 to 50 billion dollars of economic loss to these senior care operators, unfortunately. And so understanding the external forces impacting the property type that you're dealing with, is kind of that important first step. The second step involves building a business case for assessment relief. And so there are numerous common appraisal methods that are both either qualitative or quantitative in nature, and with the whole goal to measure the loss of value for either or real and personal property. So depending on the property type, there's different measuring points or metrics that you'd be looking at. For instance, with manufacturers, you'd be looking at business utilization or equipment utilization, how expenses are trending from year after year, what sales have been doing this year versus last and maybe 5 years ago. For hotels, the metrics there that you'd be looking at include average daily rate, revenue per room, and occupancy. For senior care properties, you'd be looking at your revenue, expenses, occupancy trends, all of those factors that would help an appraiser or an analyst analyze the property using the income appraisal method. So what do we find once we review properties? What I can say is that almost always we find that assessments are not correct. But during COVID times, when a property has been greatly impacted by the current recession, we could see overpayments by as much as 70% plus, with assessment differentials in comparison to an accurate market value. And so what are some of the common areas that we typically find after we have completed our diligence for analysis and review? Well, the first one is that there's a disconnect between market value and assessed value. And the second is that what's there is not what's being assessed. So in other words, are all of the physical features of the building correctly being captured on your assessment record? And many times they're not, because of omitted land use restriction determinations, or maybe the assessor got the square footage of the building wrong. I mean, there's all kinds of factors that go into rendering an accurate assessment. And so it's important to study all of those factors to make sure that you're getting a fair shake. And the third area has to do with kind of the postmortem after you've negotiated an incentive through a lot of hard work. Are you getting what was negotiated as part of the actual incentive computation? And so a lot of the incentive benefits flow through on your property tax bill. So you want to pay attention to your property tax bill to make sure that the incentive amounts are as expected. The fourth area has to do with personal property obsolescence. So, obviously you have to be in a state that assesses personal property for that to be a planning item. But personal property, especially with manufacturers, is a big area to review and investigate, and to make sure that you're getting all forms of depreciation applied on your personal property for physical, functional, and economic depreciation sources. In most states, there is an incentive to do the right thing and, as an employer, minimize emissions to the environment, and especially with air and water. And so because of that, you'll want to understand if your state exempts pollution control property, because once you properly claim the system, you likely will never pay property tax again, or the amount will be dramatically less than your other property types. Segregating your property is an area that doesn't just apply to ensuring that the buckets are correct to the feds for 3, 5, 7, and 15-year and 39-year property. Segregating the components of your assets may actually lead to property tax relief. And so it's important to make sure that you understand what exclusions or exemptions are available in your state, because segregating those items can actually lend to relief while you're actually completing the returns. In some states, we actually have found that personal property is being, or actually property is being reported on personal property filings and also being assessed again as real estate. So knowing all of the factors and components that go into your real estate can help you identify that the double valuation situations. And then the last item, again, has to do with incentives, property tax abatements, and errors that come up with reviewing your annual tax bill. So in case you're wondering, well, gosh, does this even mean much to me? I mean, my property tax bill is what it is every year. Well, we've highlighted some examples here with businesses that were maybe somewhat active with reviewing their property tax amounts from year after year, or maybe just not much at all. And so, you can see the economic benefit that was achieved by just managing the property tax amounts in the spirit of minimizing, reviewing, implementing process changes, keeping the assessor accountable. And the first one had to do with an automotive manufacturer, tier 1, and their study resulted in a $7.1 million amount for relief. This next example was with a major food ingredients manufacturer. And so they did a statewide review with our team for all of their properties. And again, they were on a percent change kind of management. Many of their properties had not been appealed for years. And we were able to help them secure a $1.7 million reduction across the board, and a gift that has kept giving to them through an annual savings of about $400,000. And we expect that amount to perpetuate for a number of years. This third example was the hotel portfolio. And so just digging into that and looking at their property with the income approach and the Rushmore method, and extracting all the components of value from their going concern and providing that support to assessors through tax appeals helped them achieve over $1 million of benefit. Very similar example with another hotel portfolio, and that led to an $880,000 relief after a previous provider was done with their review. And so just because a property tax expert has reviewed your property taxes doesn't always mean that you're in good shape, that there's no money on the table. And so it's important to gain a second perspective from time to time to make sure that you're still not overpaying despite another provider's efforts to review your property tax assessments. And these last examples have to do with senior care property experience. The first had to do with a portfolio review, led to a $2.5 million reduction. Again, just with this disciplined review and appeal approach and keeping that accountability as part of the management function of that portfolio. And this last example is with kind of a newer client that we've been helping for about a year or two. And so we've already helped them achieve a 7-digit savings of $127,000 for their properties that have been appealed and reviewed. We expect that number to continue to grow as we build that experience and build that accountability year after year. So the number one area, if you were to leave this presentation today and only take one thing away from this would probably be your biggest takeaway. Suggest that you do not go at this alone. Bring experience into the equation. Bring in someone who's been there before, who understands how to advocate, how to analyze, how to translate the loss in value that you're seeing from COVID, and to build that into your property tax management function. Starting early, at least 6 to 9 months, to plan ahead so that you're not in a fire drill when notices start coming out next year or return filings are due. Doing that will put you light years ahead of where you're at now, because you'll be meeting the protest deadlines. You'll keep your options open for reducing your assessments and achieving refunds and tax reductions. Bringing that seasoned expert will help you with creating that credible analysis that's so important as the basic building block and foundation for a successful appeal strategy or a successful return strategy for an efficient property tax payment and reporting method on that filing. It will help you and pay big dividends and increase your tax savings that you otherwise would not be able to achieve without that experience. So at JM Tax Advocates, we're here to help. We're prepared to help you with building your case. But whether you hire JM Tax or some other advocate, it's important to build that experience and evaluate the best possible resource that can tell your story during these uncertain times. And so this is a big burden area. It's something that really you cannot fall asleep at the switch, because the impact to your business is not just short term, but possibly long term, because of the increased burden of property taxes on your capital intensive business. So how do we typically work with a prospect or a client when we're kind of getting to know one another? Well, we start with taking a look at your initial assessments, providing our initial findings to you, and then asking a lot of good questions to help understand the impact of your business, possible strategies that we've seen work in the past as part of our program assessment. And then we bring these same qualified recommendations that would provide a successful roadmap for relief. And so all of that is done at no cost to your company, and so there's no risk to evaluating your property taxes. So long and short is we're here to help. We're here to be of service and help you understand where you might be able to pursue relief and to make sure you're not in an overpaying situation with unexpected costs to your business. So I'm going to leave our contact information up on the screen, or you can just go out on our website and log into our contact page. But really appreciate the opportunity to present these strategies to you today. It's been a pleasure. I wish you well during these uncertain times, and I wish much success to your business. Feel free to call on us as your experienced team, your experienced advocates, so we can help you with making sure that you're spending your money wisely, that you're not overpaying the government for property taxes, and at the end of the day, aren't seeing unexpected surprises because of that planning that really should be part of your annual property tax management function.
Find out why leading companies trust JM Tax Advocates to bring their property taxes back to reality. Get your free evaluation today.